Warren Buffett calls accounting the language of business, and he notes that it's a vitally important skill for every investor and business person to learn. Yet the sad truth is that 95% of business people don't know how to read financial statements. That's like being a professional musician but not knowing how to read music. In this video, I'll explain what the 3 financial statements are and show you line by line how they connect with each other. If you watch this video to the end, you'll literally know more about accounting than 95% of people in business. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing businesses for more than 20 years. Now, there are 3 major financial statements. They're called the income statement, balance sheet, and cash flow statement. Each statement is designed to answer a specific question about a company's financial position to give readers a more complete view of its financial health. So the income statement answers the question, are you profitable? It measures a company's revenue and expenses over a period of time to answer that question. The top number of the income statement is a company's sales or revenue during the period. From there, we subtract a variety of expenses that the company takes on. After we've subtracted those expenses, we are left with either a profit or loss on the bottom line. From there, we divide that profit or loss by the total number of shares outstanding, which gives us a profit or loss on a per share basis. The second financial statement is called the balance sheet, which answers the question, what's your net worth? The balance sheet lists all of a company's assets on one side, which is everything it owns. On the other side, it lists all of the company's liabilities, which is everything that it owes to others, and all of the equity in the business, which is called shareholders' equity. The balance sheet is called the balance sheet because of the master accounting equation, assets equals liabilities plus shareholders' equity. This equation always perfectly balances, hence the name of the sheet. The third major financial statement is called the cash flow statement, and it answers the question, are you producing cash? The cash flow statement is also measuring a company's cash inflows and outflows over a period of time, similar to the income statement. But the cash flow statement only cares about the movement of cash in and out of the business, and those cash movements are tracked in 3 general categories. The first category is called operating activities. This is all cash inflows and outflows related to operating the business. The second is called investing activities. These are cash inflows and outflows related to making investments in the business. And the third is called financing activities. This is cash inflows and outflows due to financing decisions related to the business. Now, each of these financial statements stands on its own to answer that specific question about a company's financials. However, all 3 of these statements talk to and are connected to each other. And it's by studying the connections between the financial statements that we can understand a company's financial position on a far deeper level. Now that we understand the basics, let's take a look at the financial statements of a fake company called Best Coffee Company to see how these 3 financial statements connect with each other. Here we have Best Coffee Company's income statement on the left-hand side, cash flow statement on the right-hand side, and balance sheet in the middle. Notice that the income statement and cash flow statement are measured over a period of time, January 1st through December 31st, while the balance sheet is a point-in-time snapshot taken on the last day of the period, December 31st, 2023. So to understand how the financial statements connect with each other, let's start by taking a look at how the income statement connects to the balance sheet. To do so, we're going to go line by line down the income statement and show you how each category affects the numbers on the balance sheet. The first number to look at would be revenue, which is the total sales generated during the period. Now, revenue or sales can be accounted for or paid for in 2 different ways. The first way would be if the customer makes a cash payment for those sales. For example, buying a cup of coffee for us and then paying in cash. This would directly impact the balance sheet because it would make the cash balance that we have go up. However, a customer could also pay for that same coffee using credit, in which case the business would not receive the cash immediately. We would record that transaction on the balance sheet under a category called accounts receivable, and that transaction would cause the company's accounts receivable balance to increase. The next line item on the income statement is called cost of goods sold. This is all of the costs directly related to producing the cup of coffee that was sold, and would include things like the beans, the water, and the paper products used to give the coffee to the customer. Now, Best Coffee Company could pay for those supplies in a few ways. First, it could make a cash payment to the supplier for those supplies, which would decrease the company's cash balance. Or it could use inventory that it already has on hand, which would decrease the company's inventory balance. or it could buy those supplies using credit, in which case it would increase the company's accounts payable balance. Now, the next number on the income statement is called gross profit, which is simply revenue minus cost of goods sold. This figure has no impact on the balance sheet, so we'll move on to the next number. The next category here is operating expenses, which is a catch-all category for all overhead expenses that a business takes on. Now, there are multiple ways that a business could pay for its operating expenses as well. If it paid for those operating expenses using cash, that would immediately decrease the company's cash balance. It could also pay those operating expenses on credit, and it would do so by increasing the payables that it owed to others. Now, those others could be employees of the company or suppliers that provide some of the overhead. Now, one final category of operating expenses that could be paid is something called a non-cash expense. These are real expenses that the business takes on, but they don't result in an immediate cash outflow to the business. An example of a non-cash expense would be depreciation, or the gradual writing down of the company's fixed assets. This would directly impact the balance sheet because we would mark down or depreciate the value of the fixed assets on the balance sheet. Another non-cash charge would be amortization, which is the writing down of the value of intangible assets. Just like with depreciation, taking an operating expense charge of amortization would result in the gradual writing down of intangible assets on the balance sheet. The final non-cash category is stock-based compensation. This is when an employee is compensated with stock instead of cash. Now, when stock-based compensation is paid to an employee, it's marked as an operating expense on the income statement, but it also impacts the balance sheet because it increases the additional paid-in capital of a business and simultaneously decreases the amount of retained earnings that the business has. That brings us to another profit metric called operating income, which is simply gross profit minus those operating expenses. The next line item is called non-operating expenses or income, and this could impact the balance sheet in several ways. First, any interest-generating assets that the company has, such as cash, marketable securities, and other long-term assets, would generate interest income for the business. This would be recorded directly on the income statement. Next, any interest-bearing liabilities that the company has, such as short or long-term debt, would increase the company's interest expense. That interest expense would be recorded on the income statement. Finally, we can also generate non-operating income if we sold an asset. Now, those asset sales could include selling fixed assets, intangible assets, or even selling off a part of the business. Whenever we would do an asset sale, we would increase our cash balance, but we would simultaneously decrease our long-term assets. The next number on the income statement is simply pre-tax income, which is operating income plus or minus any non-operating expenses or income. The next line item here would be taxes. Now, there are multiple ways that a company can pay its tax bill. The first way would be to pay directly with cash on hand, which would lower its cash balance. The second way would be to delay the payment of those taxes, which would increase our accounts payable total. That brings us to the bottom line on the income statement, which is called net income, which is revenue minus all of a company's various expenses on the income statement. Now, our net income total gets added to a company's retained earnings balance on the balance sheet. Retained earnings is the cumulative amount of profit that a company has generated over its lifetime as a business. So we directly add the company's net income from that period to the company's retained earning total. The next number on the income statement is the total number of shares outstanding. And then finally, we have earnings per share, which is simply net income divided by the total amount of shares that we have outstanding. So there you go. That is how the income statement directly impacts the balance sheet. Now let's move on to showing how the income statement directly impacts the cash flow statement. To show this, we're going to go line by line through the company's cash flow statement and show how each category could be impacted by the income statement. Now, the first and most important way that these two financial statements are connected is through net income. The bottom line on the income statement, net income, is the top line on the cash flow statement. So the cash flow statement starts with how much profit we generated during that period. From there, we need to make various adjustments based on whether cash came into the business or out of the business, depending on that net income. The first thing we need to account for is any non-cash charges that were recorded on the income statement. Remember, on the income statement, we recorded some non-cash charge expenses, but these did not result in an immediate outflow of cash. So we have to account for that on the cash flow statement. Now, the two categories that could include non-cash charges are the cost of goods sold on the income statement and the operating expenses on the income statement. Those non-cash charges could include things like the depreciation of fixed assets, the amortization of intangible assets, and stock-based compensation. These non-cash charges would result in a positive impact to the company's cash flow statement since they did not result in a cash payment. The next item here is to track a company's changes in working capital. Now, working capital just means things like accounts receivable, accounts payable, and inventory. These categories do not impact the income statement, they impact the balance sheet, so we'll talk about those in the next section. The next number here is cash flow from operating activities, which is simply net income plus non-cash charges plus or minus changes in working capital. This is the amount of cash flow that a business produced from operating itself during the period. From there, we next need to account for capital expenditures. This would be cash outlay spent on things like property, plant, and equipment, all of which are fixed tangible assets that a business uses to operate itself. Now, those capital expenditures are not expensed immediately on the income statement. Rather, since they have a long duration life to them, the way that we expense them on the income statement would be through taking a depreciation charge during that specific period. Now, that depreciation charge could be recorded in one of two places, either in cost of goods sold, if that equipment is used to make the product or service, or as an operating expense, if that property, plant, equipment is used for general corporate purposes. The next line item here would be any cash outlays for acquisitions. Now, making an acquisition could actually impact every single part of the company's income statement because the acquired business income statement would get incorporated into our income statement. The next line item here would be sale of an investment. The sale of investment would be accounted for in non-operating income if it resulted in an income to us. And the final number here is cash flow from investing activities, which is all the cash inflows and outflows related to making investments in the business. The next number here would be related to any changes in the company's debt balance. We could either borrow new money, which would increase our debt balance, or pay down debt that we already have, which would reduce our debt balance. Now, the amount of debt that we have directly impacts how much interest expense that we pay, which would directly impact non-operating expenses. The next number here to track would be if the company issued or repurchased any stock. If the company issued stock, that would increase our shares outstanding. And if it repurchased stock, that would decrease the shares that we have outstanding. The next number here would be any dividend payments that were made. Those dividend payments would be made to each of the individual shareholders, which is tracked on the income statement. And that brings us to our next total, which is total cash flow from financing activities. From there, we add up the net income, cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities, and that gives us the total change in cash during that specific period. We then take that change in cash and add it to the cash at the start of the period, which gives us the total cash at the end of the period. So that's how the income statement relates to the company's cash flow statement. That brings us to the final connection, which is how the balance sheet connects to the cash flow statement. Here we have Best Coffee Company's balance sheet and cash flow statement. And to show you how these two statements connect, I'm going to go line by line through the cash flow statement. Now, we already talked about net income, which is the top number on the cash flow statement. Net income directly impacts the retained earnings that is on a company's balance sheet. Next, let's account for the company's non-cash charges. If a company records a depreciation charge, that would lower the fixed assets that the company keeps on the balance sheet. If a company takes an amortization charge, that would lower the total value of intangible assets that the company keeps on its balance sheet. Finally, if a company takes stock-based compensation expense, that would increase the amount of additional paid-in capital that a company has and decrease the amount of retained earnings that a company has. The next category here is changes in working capital. And there are multiple categories that can be affected on the company's balance sheet. First would be the company's receivable balance. During a period, a company can either increase its receivable balance, which would be bad for cash flow, or decrease its receivable balance, which would be good for cash flow. It's a similar story for the company's inventory balance. If a company's inventory level is increasing, that results in a cash outflow. And if a company's inventory level is decreasing, that results in a cash inflow. The next number here is in a company's accounts payable, and it's the opposite impact of receivables and inventory. If a company's accounts payable balance is increasing, that is good for cash flow. And if a company's accounts payable balance is decreasing, that's bad for cash flow. But then we take all of those changes together, receivables, inventory, and payables, which will have a severe impact on the direction of a company's cash production. The next number here would be a company's capital expenditures, or spending on property, plant, and equipment. Now, there are multiple ways that spending on capital expenditures can impact the company's balance sheet. If those capital expenditures were paid for in cash, that would decrease the company's cash balance. If those capital expenditures were paid for with the issuance of debt, that would increase the company's debt balance. Finally, those capital expenditures would be added to the company's fixed asset balance, which would increase the fixed asset that the company has on its balance sheet. Next, let's talk about acquisitions. If a company pays for an acquisition in cash, that would decrease its cash balance. If a company pays for an acquisition by using debt, that would increase its debt balance. If a company pays for that acquisition with equity, that would directly impact the amount of equity issuance that a company has. Finally, acquisitions would also impact the company's goodwill balance. Remember that goodwill is the premium paid to acquire another business over the fair value of its tangible assets. So, making that acquisition would result in an increase in the company's goodwill balance. Finally, when one company acquires another, the acquirer takes full control of the acquiree's balance sheet. So that could literally impact every single category on a company's balance sheet if it results in buying another business outright. Next category here would be sale of investments. Generally speaking, when a company sells an investment, that results in a cash infusion. So this would directly impact the company's cash balance. At the same time, the sale of an investment where a company divested one of its previous acquisitions could result in the company decreasing its goodwill balance. Moreover, depending on the nature of the asset, it could also decrease the company's long-term asset category related to the asset that was sold for investments. The next category here would be changes in the company's debt. If the company borrowed money, that would result in an increase in the company's cash balance and a similar increase in the company's debt balance. If the company repaid debt that it already had, that would result in the decrease of the company's cash balance and a decrease in the company's debt balance too. It's a similar story for the issuance or repurchasement of stock. If a company issues new stock, that generally results in an increase in the company's cash balance and an increase in additional paid-in capital. If a company repurchases stock, that results in a decrease in the company's cash balance and a decrease in the company's retained earnings. The next number here would be dividend payments. If a company pays a dividend to its investors, that results in a decrease in its cash balance and a decrease in the company's retained earnings balance. Now, as we've already talked about, the cash flow statement tracks changes in a company's cash balance from the start of a period to the end of the period. We take that change in cash and we add it to the company's cash balance at the start of the period, which gives us the total cash balance at the end of the period, which goes directly on the balance sheet to become the company's new cash balance. Now, an important caveat to understand is that not all companies use these exact terms and layouts when they're making their own financial statements. Companies have a lot of leeway with the categories that they use to create their financial statements and even with what they call their financial statements. To make this easier to understand, I created a free ebook that has all of the different names that you might see used on a company's financial statements. If you want a free copy of that ebook, simply visit longtermmindset.co/FSS ebook or click the link in the video description. Well, thanks so much for watching. I hope that this video was useful. If so, give it the thumbs up. That really helps us out on YouTube. If you want to keep learning accounting for free, I highly recommend you watch this video next.